Federal Reserve, which is the central bank of the United States, just cut rates for the first time in about 9 months. And when you hear people say that the Fed cut rates, what that means is they adjusted the federal funds rate. The federal funds rate is the rate at which banks and credit unions borrow money from each other on an overnight basis to meet their daily needs. Their reduction was by 25 basis points, or 1/4%. The Federal Reserve will use that interest rate when it is reduced to keep money flowing through the economy easily and to stimulate hiring and economic growth. And conversely, what we've seen over the past few years is if inflation starts to present itself and become an issue, then the Federal Reserve will increase that federal funds rate to try and combat inflation from running away into a full-blown recession. When the federal funds rate is adjusted, it doesn't directly dictate what banks and credit unions charge for loans or pay on deposits, but it does certainly play a part. Because banks and credit unions are then paying slightly less to borrow money from each other to fund loans, it would follow that loans might be slightly less expensive for new applicants. We might start to see interest rates coming down a little bit on consumer loans, but it's not going to be anything dramatic, and it's not necessarily going to be immediate. So the timing of when to apply that reduction, if the reduction should be applied, is an individual decision made by the financial institutions after they weigh other factors that come into play in determining what the appropriate rate structure is. The Fed does meet multiple times per year. They'll meet 2 more times here in 2025, and they do project further cuts as long as economic conditions remain favorable.